Sonoma County inventory just jumped 31%. But here's what nobody's telling you. Some markets are absolutely surging while others are just quietly collapsing. Healdsburg sales surged 48% while Santa Rosa actually declined. And picking the wrong town could cost you $200,000. Living in Healdsburg and helping hundreds of families navigate this market, I've never seen such a divergence. So here's the big picture that nobody's talking about. Here's something that'll change how you see this market. A 31% inventory jump usually signals a crash. But we're still at 3.2 months of supply. Sonoma County added 308 homes to the market, pushing total inventory from 977 to 1,285 homes. And days on market increased 23% from 50 days to 62 days. And homes are now selling at 94.3% of their original list price. I mean, some might see this as concerning, but let me tell you what's going on here. You need 6 months of supply for a balanced market. What we're experiencing isn't a collapse. It's a market giving both buyers and sellers room to breathe. But not all cities are experiencing this shift equally. Some markets are surging while others are stalling. And understanding why could be the difference between a smart investment and a costly mistake. The county-wide numbers are hiding something crucial that I'll reveal when I tell you about the Russian River data. It's a bifurcated market story that nobody's talking about. But first, let me show you what happens town by town. Think about it. The county-wide numbers tell you almost nothing about what's happening in individual towns. I mean, Healdsburg sales jumped 48%, while Santa Rosa sales actually declined. And that's not normal behavior. That's a fundamental shift in buyer preferences and market dynamics. And this divergence matters because it reveals where opportunity truly lies. For buyers who understand these micro markets, you're looking at potential gains that dwarf the risks. But for sellers who don't, you could be leaving hundreds of thousands of dollars on the table. So Healdsburg, let's talk about that, which is really a Phoenix Rising story. After years of watching Healdsburg struggle with ultra-luxury pricing, what's happening now feels like vindication for those of us who have known the value's always been there. If you've been waiting for your chance to invest in Healdsburg, this is your moment. And the data tells a remarkable story. Sales surged 49% year over year, jumping from 14 to 21 homes. This happened while new listings actually dropped 25.7%, which is truly extraordinary. I mean, think about that for a second. Less inventory, way more sales. This isn't a supply-driven bump, it's pure pent-up demand finally unleashed. And the catalyst? Price reality. Healdsburg's median price corrected 16.4%, dropping from 1.17 million to 976,000. That's a significant price cut across this premier wine country destination. From my experience living here, I can tell you exactly what's happening. Buyers who have been circling Healdsburg for years, waiting for the right moment, they're jumping in. I'm seeing people who looked in 2022, got priced out, and are now back with offers in hand. What does this mean for you? If you've been priced out of the Healdsburg market in recent years, the entry barrier just dropped significantly. And if you own a property here and have been hesitant to sell, here's the thing. Healdsburg's the only market in the county where the absorption rate is actually improving. It's up 40% and pending sales are up 31%. So price your property realistically and you'll find motivated buyers. After living in Healdsburg for over a decade, I've watched this market through multiple cycles. What's happening now feels different. It's not desperation, it's recognition of value. The downtown plaza still buzzes with activity and the restaurants are packed. Wine tasting rooms are busy, but the prices finally make sense for actual buyers, not just ultra-wealthy second home purchasers. And Healdsburg's correction has created the best entry opportunity in years. But it's a moment that won't last for those seeking prestige markets. I mean, they recover fast and early movers capture that appreciation. So now let's talk about Sebastopol, the sort of quiet overachiever. Most investors are so focused on Healdsburg drama that they're completely missing what might be the smartest play in Sonoma County right now. While everyone's been watching Healdsburg's turnaround, Sebastopol has been quietly outperforming on nearly every metric that matters. And Sebastopol saw the region's most dramatic inventory surge. I mean, a stunning 79% increase from 40 to 72 homes over the quarter. And in most markets, that would signal trouble. But in Sebastopol, sales still grew 7.5%. And the market's absorbing this inventory better than anywhere else in the county. And the numbers tell the story. Sebastopol boasts the highest absorption rate at 33%. The county average is 31%. It's got the fastest days on market at just 54 days. That's the only market where that's actually improved. And homes are still selling at 95% of their original list price. Now here's something interesting. While the median price did dip 5.3% to 1.09 million, the average price actually increased 14.2%. I mean, that tells me the higher end segment is actually performing pretty well. This resilience makes it perfect for 1031 exchanges from Bay Area properties, and the tax advantages are substantial. But I'll analyze some investment strategies in a minute, so stay tuned. For now, let me finish explaining why this market is so resilient first. From years of helping buyers in both markets, I can tell you what makes Sebastopol particularly attractive right now is the combination of investment fundamentals and the lifestyle appeal. The town's continued evolution with developments like the Barlow and the growing culinary scenes created genuine demand from both second home buyers and those relocating full-time. I mean, it's close enough to San Francisco for weekend getaways. I mean, it's well under 90 minutes, yet it feels worlds away from urban stress. And think about this, for eco-conscious investors who value community and sustainability, Sebastopol aligns perfectly with those values. The town's got a well-deserved reputation for environmental stewardship and independent spirit. I mean, that makes it attractive to buyers who want to feel good about where they're investing. And there's something most people miss about Sebastopol. This place is not trying to be Healdsburg or not trying to be Sonoma or St. Helena. It has its own identity. I mean, the farmers market, the community events, the mix of artists and tech workers and the retirees. That creates a really diverse market with great resilience. And Sebastopol's ability to absorb a 79% inventory surge while maintaining price stability proves something important. This isn't a market dependent on speculation or tourism. It's a genuine community. So now let's talk about Sonoma City. It's a selective market that's fooling everyone. You'd think 11% appreciation means Sonoma City is the real winner here. That surface level analysis is exactly how investors make expensive mistakes. So Sonoma City presents as an interesting paradox that sophisticated investors need to understand. The median price increased 11% from just over $950,000 to $1.06 million. And that's the only market with double-digit appreciation in the entire county. But here's where it gets complicated. I mean, really complicated. I mean, dig deeper and you'll see the full picture. Sonoma's absorption rate is the weakest in the region at just 20.6%. I mean, sellers are being forced to cut prices more aggressively than anywhere else. And homes are selling at just 91% of their original list price. And the county average is nearer 95%. What this tells us is that Sonoma City sellers who price realistically are still achieving strong appreciation. But the market's highly selective. Overpriced homes sit, and when they do sell, it's only after significant price reductions. And days on market increased to 70 days. And I've watched this pattern before in other markets. It's the beginning of a shift where buyers are gaining leverage. But they know they have options. They know they can negotiate. And sellers who don't recognize this new reality just get stuck. For buyers, this represents leverage. If you've been eyeing Sonoma's wine country charm, the central plaza lifestyle, and proximity to Napa, you now have negotiating power. I mean, really significant negotiating power. From experience, here's what works in this kind of market. Come in 5% below recent comparables, create urgency with strategic pricing, and don't chase the market down with incremental cuts. Sonoma City's selective nature creates opportunities for prepared buyers. When sellers need 9% price cuts to close deals while the median still shows 11% appreciation, you're looking at a market in transition, and smart money recognizes those moments and acts accordingly. So now let's talk about Windsor, which is definitely an inflection point that could go either way. I mean, what if I told you the strongest market on paper could be the riskiest in Sonoma County? Well, that's Windsor's story right now. Initially, Windsor looks like a success story. Sales are up nearly 20%, prices are essentially flat at $800,000, but homes are still selling at 97% of the list price. But here's the thing, and this is crucial if you're considering Windsor. Beneath those surface level positives, warning signs are flashing. Inventory doubled, up 56% from 31 to 48 homes, and that's concerning, with absorption rates collapsing from 62% to 46%. And perhaps most telling, pending sales actually declined. And Windsor's the only market with falling forward momentum. And what's happening in Windsor right now is textbook inflection point behavior that I've seen play out numerous times. I'm saving the most important insight about market timing for just a little bit. The key is recognizing which side of the curve we're on. I mean, what's happening here is classic. Windsor has been a family market favorite. Affordable, good schools, easy commutes. That continues to draw buyers. But supply's now growing faster than the market can absorb. And sellers haven't yet adjusted their pricing expectations to reflect this new reality. After years of helping families choose between Windsor and other Sonoma County cities, I can tell you this, the market hasn't fully corrected yet. Homes still command 97% of the list price, but the momentum is clearly shifting. For buyers, this could represent an opportunity on the horizon. And watch this market carefully over the next quarter. If inventory continues building and absorption rates continue falling, you'll see motivated sellers emerge for sure. For sellers, here's my honest advice. The window to capture top dollar is closing. The market is still strong enough to achieve good prices, but waiting another quarter could mean facing much much stiffer headwinds. And Windsor's inflection point offers both maximum risk and potential reward. Understanding market cycles means recognizing that today's strength can become tomorrow's weakness. With pending sales already declining and absorption rates collapsing, the direction seems clear. The only question is timing. So now let's talk about Santa Rosa, that should be leading this recovery. Instead, it's the only major market moving backwards. And the data point I'm about to share should worry every owner. As Sonoma County's largest city and traditional anchor, Santa Rosa's performance reveals a troubling pattern. And I mean, this is something investors really need to understand. Sales actually fell nearly 3% to 129 homes, and that makes Santa Rosa the only major city with declining sales volume. New listings have essentially been flat for nearly 2 years running. We're seeing 155 homes in both Q3 24 and Q3 25, yet the market can't absorb what's available. And the absorption rate collapsed 26% down to 32%, and days on market increased to 59 days. And now the median price declined just around 3% down to $738,000. And on the surface, this sort of looks like stability. And Santa Rosa's affordability advantage means nothing if the market keeps declining like September showed. I mean, let me explain what I mean. September 25 saw the median price drop to $703,000. That's accelerating a downward trend from the July and August average of $755,000, which is particularly concerning. What we're witnessing in Santa Rosa is a market that's lost momentum. While inventory is growing in line with the county average, up 32%, buyers aren't responding with the same enthusiasm we're seeing in other markets like Healdsburg or Sebastopol. From my perspective, having watched this market for years, Santa Rosa's treading water in a market where other cities are swimming and moving forwards. Properties are taking longer to sell. Absorption rates are falling faster than the county average, and that September pricing data suggests the market may be softening further heading into Q4. For investors, Santa Rosa offers the most affordable entry point in Sonoma County. The median price of $738,000 is, $300,000 less than somewhere like Sonoma City. I mean, if you're seeking cash flow from rentals and can find properties at the right price, Santa Rosa's size and rental demand could work. But if you're looking for premium wine country lifestyle and strong appreciation, this perhaps isn't the place where to find it. Santa Rosa's September decline to $703,000 isn't just a data point. I think it's a warning. And markets don't suddenly reverse declining sales, collapsing absorption rates, and accelerating price drops. They need to find a bottom first, and we're not there just yet. And now to Russian River, the value play for those who see opportunity. I mean, I always heard how paying $500,000 for a wine country living sounds impossible, but Russian River's correction has created exactly that opportunity. If you understand what you're buying, it's a good place to look. If you've been priced out of some of Sonoma County's other wine country lifestyle places, then Russian River's Q3 performance deserves attention. The median price declined nearly 9% to $557,000, and that's a September low for sure. For context, that's $450,000 less than somewhere like Sebastopol or Sonoma City. And this represents a significant price correction in the county. And here's where it gets interesting. I mean, this is something most people completely miss. While the median price fell nearly 10%, the average price actually increased 7% to $706,000. And this isn't data error. It's a bifurcated market. Remember when I mentioned the county-wide numbers were hiding something? Well, this is it. A tale of two markets where one area that reveals everything about where value truly exists. The entry-level properties are correcting hard, while quality homes are appreciating. What we're seeing is a correction in the entry and mid-range properties, likely older homes or properties with some challenges associated with that. Meanwhile, the upper tier of the Russian River market, meaning places that have been remodeled or turnkey properties, they're holding strong and even appreciating a tiny bit. And sales declined 10% down to 29 homes, and new listings also fell. But days on market increased to 72 days. The absorption rate fell to 31%, right at the county average. And homes are selling at 95% of their original list price. I mean, the great thing about the Russian River, you've got the river lifestyle, as well as access to wineries. And it's all in a beautiful rural setting with redwood trees. From experience, insurance can be challenging in some of these areas, particularly for properties in flood zones or higher fire risk areas. And the commute to San Francisco or Silicon Valley is definitely longer than some other places in Sonoma County. Russian River's bifurcated market creates a clear opportunity. Buy the right property at $500,000 and you're getting wine country living at 2015 prices. But the wrong one, and you could be catching a falling knife. The difference? Condition and location within the area. Knowing these factors, and Russian River becomes a really good value play right now. And what this market shift really means to you? Well, after analysing thousands of data points, points, here's the brutal truth. Most buyers will choose the wrong market because they're looking at last year's playbook. Let me break this down with all the data and what it actually means for you investing in Sonoma County. I mean, if you're a buyer seeking entry into Sonoma County, Healdsburg offers the good combination of both prestige and newly accessible pricing. I mean, you're buying into a market that's corrected and is now surging with legitimate demand. Sebastopol offers the best value proposition for sure. It's resilient, well-priced, and absorbing inventory like a true champion. The market timing insights I'm about to share will be crucial for your decision because what's coming in 2026 will dramatically impact which markets outperform. But first, understand your current position. If we're looking to downsize or divest from Bay Area property, the strong appreciation in Sonoma County demonstrates that wealth preservation is still possible in wine country. But you'll need to price realistically. I mean, really realistically. Sebastopol's resilient markets makes it an excellent 1031 exchange target if you're rolling proceeds from a larger property. Now, if you're seeking a second home investment with rental potential, think about this. Sebastopol's strong absorption rate and faster days on market suggest healthy vacation rental demand. And Healdsburg's recovery makes it attractive for those seeking premium positioning in a beautiful town. Windsor's shifting dynamics mean you could negotiate better if you're patient. And if you're already invested here, let me tell you what this data suggests. Healdsburg owners should feel confident about long-term value, but accept that the market has reset pricing expectations. Sebastopol owners are sitting pretty with strong demand, limited supply, and solid fundamentals. And Windsor owners should consider selling sooner rather than later if they're contemplating a move. Your success in this shifted market depends on matching your goals to the right micro market. Generic county-wide strategies no longer work. So whether you're preserving wealth, seeking appreciation, or building cash flow, the opportunity exists, but only in the right location at the right price point. So what's the bigger picture beyond the numbers? Numbers tell you what's happening. Living here tells you why it matters. And after a decade of living here, I can tell you the lifestyle value transcends any spreadsheet. From years of living and working here, I can tell you what makes these markets genuinely appealing for lifestyle investors is that are things that you can't quantify. It's Healdsburg's walkability downtown to the plaza. After living here, I still discover new favourite spots. It's Sebastopol's farmers market culture and community spirit, that sense of belonging you just don't find in Silicon Valley. It's Sonoma's historic charm and proximity to both wine regions. For many of you, the investment decision is ultimately about more than ROI and appreciation curves. It's about where you want to spend your mornings having coffee and afternoons exploring wineries, your evenings watching the sunset roll over vineyards. I mean, the beauty of Sonoma County is that you can achieve both, a sound financial investment and a lifestyle upgrade that money can't buy anywhere else. The key is understanding which markets align with both your financial objectives and your vision for how you want to live. I mean, beyond investment returns, you're buying into a lifestyle that Silicon Valley money just can't replicate. Wine country living offers something very intangible, from community to beauty, pace of life, that makes the financial analysis secondary for many buyers. And honestly, that emotional premium is what protects values long term. So what to watch in the coming months? Well, 4 factors will determine which markets explode and which implode over the next 12 months. Missing any of them could cost you hundreds of thousands of dollars. As we move through the rest of 2025 and into 2026, several will influence these market dynamics. And honestly, you need to pay attention to them all. First, we've got interest rates. If rates continue to moderate, expect demand to strengthen across all segments, particularly in markets like Healdsburg that have already experienced a correction to more accessible price points. And second, Bay Area economic health. I mean, Sonoma County's market is inextricably linked to the Bay Area, and in particular AI right now. Strong stock market performance and the tech sector stability will continue to drive investment here. I mean, particularly for second homes and lifestyle properties. Third, and this is an important factor as well, is the wildfire and insurance. And this is always something that impacts this market, as it does everywhere across California. And then fourth, the supply pipeline. Healdsburg's 25% drop in new listings suggests that supply constraints that could support continued price stability and increase. Sebastopol's ability to absorb this inventory surge suggests it could handle additional supply without price pressure. From experience, I've learned that markets shift gradually and then suddenly. The gradual part is happening right now. The sudden part comes when buyers and sellers finally recognize the new reality. And these 4 factors will create winners and losers. Interest rates favor corrected markets like Healdsburg. Tech wealth supports premium areas. And insurance availability kills rural markets while boosting cities. And supply constraints create urgency. So making your market move in this shifted market, well, the difference between acting now and waiting 3 months, in Healdsburg, about $50,000. In Windsor, could save you $100,000. Timing has never mattered more. And here's what I tell clients who are trying to navigate this shifted market. Success now requires sophistication, understanding absorption rates, recognizing supply-demand imbalances, and most importantly, knowing which micro markets align with your specific investment thesis and your lifestyle vision. The winners, Healdsburg and Sebastopol, are winning for different reasons. Healdsburg's found its price point. Sebastopol proved its resilience by absorbing massive inventory without breaking stride. And both represent compelling opportunities for different types of investors. The cautionary markets like Windsor and Santa Rosa, they're not broken, they're just signaling they need careful analysis. Inflection points present both opportunity and risk. Understanding which side requires local expertise and current data. After years of helping buyers navigate the decisions, I can tell you this. The difference between picking the right market and the wrong one isn't just about money. So as I mentioned earlier, we're talking about potential differences of a couple of $100,000. It's about understanding where the market's headed, not just where it's been. It's about recognizing value before everyone else does. And it's about matching your personal goals with the market reality. Think about it this way. Q3 25 is giving the clear picture of Sonoma County market that's maturing. It's differentiating and it's offering distinct opportunities depending on your objectives. For those of you who've worked hard, built wealth, and are ready to deploy it in a place that offers both financial returns and lifestyle rewards, Sonoma County continues to deliver. The days of uniform appreciation across all markets is behind us for right now. The divergence between winners and losers, I believe, will accelerate. Healdsburg and Sebastopol will continue to attract smart money. Windsor and Santa Rosa need catalysts to course correct. Your success depends entirely on reading those signals correctly. So the market is not broken, it's just more interesting than ever. Whether you're seeking your dream wine country property, looking to divest from Bay Area real estate while preserving wealth, or building a portfolio of Sonoma County rentals, the opportunity exists. If you're ready to navigate a market that's shifted, as someone who's lived here for a while, we can help you make the decision. Just email me at david@BruingtonHargreaves.com. We can chat about your specific situation and how the different markets align with your goals. Definitely check out the video I've linked here, where I break down the 3 biggest mistakes Bay Area buyers make when purchasing in wine country. After helping hundreds of families make this transition, these are the pitfalls that can both cost you and make you money. Until the next video, go well.